It's clearly worrisome. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been. What I say is we never know where we're going, but we sure as hell ought to know where we are. And if we can be analytical about what's going on in the markets today, that has implications for tomorrow. Remember, in 1980, the Fed funds rate was 20, and I had a loan outstanding from a bank at 22.25. 40 years later, the Fed funds rate was 0, and I had a loan outstanding from a bank at 2.25. So the decline of interest rates by 20 percentage points over that period was a dominant factor in the financial world. I think it was the most important single event in the financial world in the last 50 years. It doesn't get the credit. In the period 09 through 13, the Fed took Fed funds rate to 0 to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal range.
The warning signs. A financial storm. Think about the feeling of walking outside just before a major storm hits. The air is thick, the sky is heavy, and even though it hasn't started raining yet, you can sense what's coming. That's exactly where we are right now with the global economy. Except this storm isn't just a passing shower. It's a financial hurricane, and it's heading our way fast. We've seen the warning signs before, but this time the stakes are even higher, and if we don't pay attention, the consequences will be devastating. So, what exactly are these signs? Why should we be so concerned? One of the biggest red flags is the national debt, which is now sitting at unprecedented levels. To put it in perspective, the U.S. national debt has surpassed $33 trillion. For decades, we've been borrowing money to fund wars, social programs, and government spending, but there's a limit to how much debt the economy can sustain. Right now, we're at a tipping point. In the past, this kind of reckless borrowing has led to inflation, devaluing the currency, and making everyday life more expensive. And if you've noticed prices rising faster than your paycheck lately, you're already feeling the effects. Inflation may seem like an abstract concept, but when it starts cutting into your ability to afford basic necessities, it becomes all too real. But inflation isn't the only problem. Let's talk about consumer debt, specifically credit card debt, which has hit an all-time high of over $1 trillion. That's right, Americans are relying more on credit than ever before to keep up with the rising cost of living. But here's the kicker. With interest rates continuing to climb, paying off that debt is getting harder by the day. The more people rely on credit to make ends meet, the closer we get to a breaking point. At some point, those credit card bills will come due, and millions of people will find themselves unable to pay. When that happens, we could see a wave of personal bankruptcies that dwarfs what we saw during the 2008 financial crisis. And let's not forget about the housing market, which is already starting to show cracks. More and more homeowners are finding themselves in a situation known as being underwater on their mortgages. This means they owe more on their homes than those homes are actually worth. It's a dangerous place to be, and it's eerily reminiscent of the lead-up to the 2008 housing crash. In some states like Kentucky, the percentage of underwater mortgages has risen sharply, signaling that the housing market bubble is, once again, on the verge of bursting. With mortgage rates now pushing upwards of 7%, many people who bought homes during the recent boom are stuck with properties that are quickly losing value. So, what does all of this mean for you? Well, the financial storm that's brewing is going to hit everyone, from the ultra-wealthy to those living paycheck to paycheck. But here's the thing. You can't afford to ignore it. If you're already feeling the pinch of rising prices and increasing debt, it's time to take action. The storm isn't going to wait, and the longer you put off preparing, the harder it's going to be to weather it. But here's the twist. What we're seeing now is just the beginning. In the next section, we'll explore how history is repeating itself and why this collapse could be even more devastating than the ones that came before it. Stick around, because understanding the past is the key to surviving the future. Historical parallels. Lessons from the past. To understand the economic storm we're facing today, we have to look back. History has a habit of repeating itself, especially when it comes to financial markets and economic collapses. Let's start with one of the most infamous economic downturns in modern history, the Great Depression of 1929. Most people know it as the era when stock markets crashed, unemployment soared, and families across the globe struggled to make ends meet. But the Great Depression didn't happen overnight. It was the result of years of speculative investing, unsustainable growth, and a mindset that the economy would keep booming indefinitely. Sound familiar? In the 1920s, much like today, people were borrowing heavily to invest in the stock market. They believed that the market would continue to rise, so they took on massive debt, buying stocks on margin, which means they were using borrowed money to finance their investments. It worked for a while, stocks soared, and many people made fortunes. But then, the bubble burst. On October 29, 1929, known as Black Tuesday, the stock market collapsed. In a matter of days, fortunes were lost, banks failed, and unemployment skyrocketed. What followed was a decade of economic hardship that we now know as the Great Depression. The parallels between then and now are striking. Today, we see people borrowing heavily to buy homes, cars, and other assets, all while assuming that the good times will continue. But history shows us that this kind of unchecked borrowing and spending is unsustainable. When the market corrects, those who are over-leveraged, the ones who have borrowed more than they can afford to repay, will be hit the hardest. Next, let's fast forward to the dot-com bubble of the late 1990s and early 2000s. The internet was booming, and everyone wanted a piece of the action. Investors poured money into tech startups, many of which had no real business models or revenue streams. The promise of the new economy convinced people that these companies would eventually turn a profit, and stock prices for tech companies soared. But once again, the bubble burst. In 2000, the dot-com bubble collapsed, wiping out $5 trillion in market value and sending shockwaves through the global economy. Companies that were once worth billions disappeared almost overnight, and many investors were left holding worthless stocks. The lesson here is clear. When people invest based on speculation rather than fundamentals, the result is often disaster. In today's economy, we're seeing similar behavior. Investors are throwing money into assets like cryptocurrency and real estate, betting that prices will continue to rise indefinitely. But as we've learned from history, markets are cyclical. What goes up must come down, and when it does, the fallout can be catastrophic. Perhaps the most recent example of history repeating itself is the 2008 financial crisis. The housing market was booming, fueled by easy access to credit and the widespread belief that real estate values would continue to climb. Banks were handing out subprime mortgages to people who couldn't afford them, and investors were buying up mortgage-backed securities, believing that housing was a safe bet. It wasn't. When the housing bubble burst, it triggered a global financial meltdown. Millions of people lost their homes, banks collapsed, and governments were forced to bail out financial institutions to prevent a total economic collapse. But here's the scary part. The conditions that led to the 2008 crisis are still present today. The housing market is once again overheated, with prices soaring and buyers taking on more debt than they can handle. Consumer debt is rising and interest rates are creeping up. If history is any guide, we're heading for another collapse, and this one could be even more devastating than the last. But we're not done yet. In the next section, we'll take a closer look at who will be hit the hardest by the coming collapse, and why younger generations in particular are in the most precarious position. Stay with me, because this is where things get personal. Generational impact, the price of ignorance. Picture this. You're a millennial or part of Gen Z, and after years of struggling through a pandemic, uncertain job markets, and rising costs of living, you finally feel like you're starting to get ahead. Maybe you've managed to land a decent job, set aside some savings, or even buy your first home. But just as you start to build some stability, a financial collapse hits, erasing all the progress you've worked so hard for. This isn't just a hypothetical scenario. It's the looming reality that many younger generations face today. Millennials and Gen Z have grown up in an era of economic volatility, and many of them came of age during or in the aftermath of the 2008 financial crisis. For millennials, the housing crisis and recession left deep scars. Many graduated college with significant student loan debt, only to face one of the worst job markets in modern history. Jobs were scarce and wages stagnated, leaving many struggling to build financial stability. Fast forward more than a decade, and that burden still lingers. Millennials are the generation most affected by rising housing costs, student debt, and a job market that often feels like a gig economy trap. In fact, millennials today are more likely to rent than own, and those who do own homes are often stretching themselves financially to make mortgage payments. Then there's Gen Z, who entered adulthood with an already precarious economic outlook. This generation has been dubbed the digital natives, growing up in a world of rapid technological change where side hustles and gig jobs are common. But while Gen Z is often hailed as tech-savvy and entrepreneurial, they also face higher levels of financial insecurity than any previous generation at their age. A significant portion of Gen Z is carrying student loan debt, struggling with the high cost of living, and entering a job market where entry-level positions no longer offer the stability they once did. According to a recent study, 41% of Gen Z employees are living paycheck to paycheck. Combine that with the rising costs of housing and inflation, and it's clear that this generation is walking a financial tightrope. Now, let's talk about homeownership, a traditional symbol of financial stability. For millennials and Gen Z, the dream of homeownership has become increasingly elusive. Housing prices have surged over the past decade, and while interest rates were low for a time, the current environment of rising rates is making it harder for younger people to get on the property ladder. Even those who manage to buy a home often find themselves stretched thin with high mortgage payments that eat into their ability to save for emergencies or invest for the future. And what happens if the housing bubble bursts, as Patrick Bet-David and other experts predict? These young homeowners could find themselves underwater, owing more on their mortgages than their homes are worth, just like many did in 2008. But it's not just about housing. Student debt is another significant burden that's shaping the financial future of younger generations. Millennials hold the largest share of student debt in the U.S., with over $1.7 trillion in outstanding loans across the nation. For many, student loan payments eat up a large portion of their monthly income, making it harder to save for emergencies, invest, or even think about retirement. Gen Z, though not yet carrying as much student debt as millennials, is expected to face a similar uphill battle as tuition costs continue to rise. This debt weighs heavily on younger people's ability to accumulate wealth, putting them at a financial disadvantage from the start. Here's where it gets even more concerning. The collapse that experts are predicting could wipe out the savings and investments of these younger generations, setting them back even further. The savings that millennials and Gen Z have managed to build up, whether through traditional savings accounts, retirement funds, or stock market investments, could be severely impacted by a market downturn. If the stock market crashes, those with 401ks or IRAs could see their retirement savings evaporate overnight. And for those who have been diligently saving for emergencies or big purchases, inflation and rising costs could quickly erode the value of their cash reserves. But there's more. The ripple effects of an economic collapse won't just impact these generations financially, it could also have a profound psychological impact. After all, millennials and Gen Z have already lived through one major financial crisis in 2008, and for many, the scars of that experience are still fresh. Another collapse could lead to a widespread loss of faith in the economic system, as younger generations may come to believe that the deck is permanently stacked against them. This could result in a more risk-averse mindset, where people become hesitant to invest in the stock market, buy homes, or even start businesses out of fear of losing everything again. In the next section, we'll explore what you can do to protect yourself from the coming collapse, whether you're a millennial, Gen Z, or from any other generation. The key is preparation, and it's never too late to start planning for the future. Stay tuned, because the strategies we'll discuss could be the difference between surviving the collapse and thriving in its aftermath. Expert opinions, the consensus on crisis. The economic warning signs we discussed earlier, the soaring debt, unsustainable consumer behavior, and housing market instability, aren't just isolated issues. They are part of a much larger pattern that has financial experts across the board sounding the alarm. So, what are other experts saying, and how does their analysis align with Bet David's predictions? One of the most prominent voices echoing these concerns is Danielle DiMartino Booth, a former advisor to the Federal Reserve and now a leading economist. Booth has repeatedly warned that the Federal Reserve's aggressive monetary policies, specifically the prolonged low-interest rate environment, have created an artificial sense of security in the economy. These low rates have encouraged borrowing and spending, much like they did before the 2008 financial crisis. In her view, we are now dealing with the consequences of those policies: over-leveraging, excessive risk-taking, and a housing market that is again teetering on the edge of collapse. Booth predicts that when the Fed inevitably tightens monetary policy, it could send shockwaves through the financial system, triggering a severe correction. Ray Dalio, the billionaire founder of Bridgewater Associates, the world's largest hedge fund, has also spoken extensively about the risks facing the global economy. Dalio argues that the debt cycle we are currently in is reaching its breaking point. He describes the situation as a big debt crisis, where governments and central banks have exhausted their ability to prop up the economy through stimulus and monetary easing. According to Dalio, the combination of high debt levels, rising inflation, and social unrest is setting the stage for a period of economic chaos that could dwarf previous crises. Dalio has emphasized the importance of preparing for this shift by diversifying investments, holding assets in safe havens like gold, and being ready for market volatility. On the geopolitical front, there's also growing concern about the impact of global instability on the economy. Nouriel Roubini, a professor of economics and one of the few who predicted the 2008 financial crash, has raised the alarm about the potential for a major geopolitical event to trigger the next financial collapse. Roubini points to rising tensions between the U.S. and China, energy crises, and the ongoing conflict in Ukraine as potential catalysts for a global recession. Roubini warns that these geopolitical risks could disrupt supply chains, increase commodity prices, and lead to a sharp decline in global trade, which would further destabilize already fragile economies. So, with multiple experts from various fields painting a similarly bleak picture, what's the consensus on how to prepare for what's coming? Let's break it down into three core themes that these experts consistently highlight: cash reserves, diversification, and upskilling. First, there's a near-universal agreement on the importance of holding cash reserves in preparation for an economic downturn. The idea here is simple. In times of economic collapse, cash is king. Having cash on hand gives you the flexibility to take advantage of opportunities that may arise during the downturn. For example, when the stock market crashes, investors with cash can scoop up valuable assets at deeply discounted prices. Bet David recommends keeping 15 to 25% of your portfolio in cash, while experts like Howard Marks, another renowned investor, suggest that having liquidity is one of the most critical strategies during market uncertainty. But simply holding cash isn't enough. The second piece of advice from experts like Dalio and Booth is to diversify your investments. In a financial collapse, traditional investments like stocks and bonds can lose significant value. That's why experts recommend spreading your risk across various asset classes, including precious metals like gold and silver, which tend to hold their value during times of economic crisis. Gold, in particular, is considered a safe haven asset because it is not tied to the performance of any one country's economy. Dalio, for instance, has long advocated for holding 5-10% of your portfolio in gold as a hedge against inflation and market volatility. The third theme is upskilling and career protection. When the economy collapses, job losses are inevitable. We saw this during the 2008 financial crisis, when millions of people lost their jobs as companies downsized to cut costs. According to Bet David, this is why it's essential to focus on becoming an expert in your field. In tough economic times, companies tend to retain their most valuable employees, those who possess specialized skills that are difficult to replace. This means that now is the time to invest in yourself, whether it's by learning new skills, earning certifications, or gaining expertise in a growing industry like technology or healthcare. Experts like Gary Vaynerchuk echo this sentiment, advising people to use the economic downturn as an opportunity to build knowledge and stay ahead of the curve. But we're not done yet. In the next section, we'll break down specific, actionable steps you can take right now to protect yourself and your family from the coming financial storm. Stick with me, because this is where we get into the practical details. Preparing for the collapse. Practical steps. Now that we've laid out the grim reality of the coming economic collapse, the next logical question is, what can you do to protect yourself? While no one can fully predict the exact timing or extent of the downturn, there are practical, concrete steps you can take to mitigate the risks and position yourself to come out on the other side, not just surviving, but thriving. The key to preparation is taking action before the collapse hits, not reacting after it's too late. 1. Build your cash reserves. The first and most critical step is to build a healthy cash reserve. In times of economic collapse, cash becomes your best defense. Unlike investments in the stock market or real estate, cash doesn't lose value overnight in the event of a crash. It offers you liquidity, meaning you can take advantage of opportunities when others are scrambling for funds. For example, when the market bottoms out, cash will allow you to purchase stocks or real estate at rock-bottom prices, securing assets that will likely regain and exceed their value when the economy stabilizes. Think of your cash reserve as your financial insurance policy. Ideally, you should aim to save 3 to 6 months' worth of living expenses in an easily accessible savings account. This cash buffer ensures that if you lose your job or face unexpected expenses, you won't have to go into debt or dip into your long-term investments. It's also a good idea to diversify your cash into different currencies or accounts, especially if your country's economy is at particular risk. This will protect you from local inflation or currency devaluation, which is common during economic turmoil. 2. Avoid large debts and real estate investments. The next step is to rethink any major financial commitments, particularly large real estate purchases or business investments. While owning property can be a great long-term investment, buying real estate just before a market crash could leave you underwater on your mortgage, where you owe more than the property is worth. This was a common scenario during the 2008 financial crisis, where many homeowners were left with properties that significantly declined in value, forcing them to either sell at a loss or remain trapped with their debt. If you've been considering purchasing a home, especially a large or expensive one, it might be wise to wait until the market corrects. Not only will this save you from the risk of losing equity, but you'll also have the opportunity to buy at much lower prices after the market stabilizes. On the flip side, if you already own property, now is a good time to evaluate whether it makes sense to pay down your mortgage or hold off on expensive renovations that may not increase your home's value in a declining market. When it comes to debt, this is the time to reduce any high-interest obligations. Paying off credit cards, personal loans, or any other forms of high-interest debt will save you from financial stress if your income takes a hit during the collapse. Additionally, avoiding new debt will keep your monthly expenses low, allowing you to weather any economic downturn with more financial flexibility. 3. Diversify your investments. One of the most important strategies for protecting your wealth during an economic downturn is to diversify your investments. When a collapse happens, certain markets, like stocks or real estate, are hit harder than others. By spreading your assets across different sectors, you reduce the risk of losing everything at once. The goal is to ensure that while some of your investments may take a hit, others will remain stable or even increase in value. Precious metals, such as gold and silver, have historically been safe havens during times of economic uncertainty. Unlike stocks or bonds, gold has intrinsic value that isn't tied to the health of any particular market or economy. By holding a portion of your portfolio in gold, you protect your wealth from inflation and currency devaluation. Cryptocurrencies, while volatile, may also provide a hedge, but they should be approached with caution due to their unpredictability. Another essential aspect of diversification is investing in international markets. While your local economy may be facing a downturn, other countries or regions could be experiencing growth. By investing in foreign stocks, bonds, or funds, you protect yourself from localized economic risks. Additionally, consider diversifying your income streams. If possible, develop multiple sources of income, such as freelance work, rental income, or side businesses. This will reduce your reliance on any single job or industry, giving you more financial resilience in tough times. 4. Protect your career and upskill. The economic collapse won't just affect markets and investments, it will also have a significant impact on the job market. During times of economic hardship, companies often downsize or go bankrupt, leaving millions unemployed. The people who are most vulnerable in these situations are those who haven't positioned themselves as indispensable to their employers. This is why upskilling, learning new marketable skills that make you more valuable, is one of the best ways to protect yourself from layoffs or unemployment. Start by analyzing the trends in your industry. Is your current role likely to be downsized, or can you pivot to an in-demand field? For instance, technology, healthcare, and renewable energy sectors are expected to grow even in tough economic times. Consider gaining certifications or learning new technologies that can increase your value to your current or future employers. Taking online courses, attending workshops, and building your professional network will also help you remain competitive in the job market. Another way to safeguard your career is by building a side hustle or freelance business. This doesn't necessarily mean leaving your full-time job, but having a secondary source of income will give you financial breathing room if your main job is affected by the downturn. Whether it's freelance writing, graphic design, tutoring, or consulting, these additional income streams can prove invaluable during times of economic uncertainty. The time to act is now. Whether you're a seasoned investor or just starting out, these practical steps will help you protect your wealth, your career, and your future. Don't wait until the collapse is upon us. Start today. And if you found this information helpful, make sure to like, share, and subscribe so you can stay informed on the latest strategies for navigating these uncertain times. In the next video, we'll dive even deeper into the strategies that successful investors use to not only survive, but thrive during market downturns. See you there.